It's Italy and the populist government there sticking to its position on next year's budget, refusing to bow to EU criticism. Controversy over the country's budget has roiled Italian markets over the last few weeks, weighing on equities. And we just saw that their bond yields have been pushed to over 3.5% for the first time since 2014. Speaking to Bloomberg, European Stability Mechanism Managing Director Klaus Regling expressed concern about the nation's fiscal plans.
Because the fiscal targets announced by the new governments that came into office a few months ago are out of line with the agreed fiscal framework that euro area countries have given themselves. So they have already adjusted a little bit in response to the criticism. So we have to wait and see, but there's a potential for a conflict.
Andrew Sheets, Chief Cross-Asset Strategist at Morgan Stanley, is still with us. And I wonder what you think about this in terms of Italy. I wonder what you think of this in terms of the euro as well. But let's start with the more specific question, Andrew. I mean, 3.5% is a pretty juicy yield, and the Italians seem to have these flare-ups quite a lot, and they never get completely out of control. Do you go in and buy those bonds?
Well, so far, our rate strategists are staying on the sidelines. I think as the previous clip just showed, this is still an evolving process. You still have some uncertain and outstanding issues with what the rating agencies will do. But for the moment, I think that uncertainty is being balanced by the fact that the yields have repriced a pretty significant amount. And certainly if you're an investor in dollars or another currency, the hedged yield on Italian assets is very high. But I think where we've been more focused is on the equity side. You know, you showed a chart, I think a pretty good one, kind of showing where the spread move on Italy was in the historical context. You've seen in the eyes of our equity analysts a much bigger repricing of Italian equities kind of relative to that history than you have on the bond side. So I think you could argue that there's quite a bit on the price of the Italian equity market, even though it remains uncertain, kind of relative to what's being priced into bonds. I saw a really interesting chart earlier on today, Andrew, with regards to Italy and where its credit rating, or where the CDS rather, would suggest its credit rating should be, and it suggests it's quite an outlier, that the Italian CDS is pricing in such a way that that the ratings agencies have some catch-up to do here. Do we expect that there'll be a downgrade? Have other markets already priced in that there'd be some sort of downgrade, do we think? I think this is a really difficult question, because I think you're right. For a BBB-rated country, for BBB-rated credit, Italy is clearly, Italian CDS is clearly wider than where the average of that price is. But this is also a very unique country, right? We're talking about, the third largest bond issuer or the fourth largest bond issuer in the world, depending on how you count it. A lot of people have exposure. The sovereign CDS market is also probably not the most fully functioning market or the most fully balanced market, which makes it a little bit more complicated. So, look, I do think the ratings here do matter. I think we, by the end of the month, should have a better idea of how the rating agencies are going to respond to this. And I do think a lot of investors will take a cue from that. I think if you see a lack of action there or more stable action there, then I think a lot of investors who have been trimming Italian positions could use that as an opportunity to move back in.
What does this mean in terms of the euro? There were a lot of people predicting the euro would just keep climbing up to past 120, as opposed to the beginning of the year when people were saying parity was more likely. Is this a concern for the European Union as we get this, crunch time for Brexit speech again this week, as we, do every week? Is that a concern for the European Union? Is the euro's strength insured?
Well, I do think the euro continues to strengthen here. I mean, it does seem hard to imagine that given the uncertainty around Brexit, given some of the uncertainty around Italy. But, this is a currency that is extremely cheap. It's extremely cheap on almost any measure you look at. I think it's in our analysts' view, cheap enough where, every country, or almost every country in Europe, including Italy, is competitive at a 116, 115 euro dollar level. It doesn't need to be weaker to make these countries competitive on the global market. And, I think underlying all these political headlines, the data in Europe has been better, I think, than a lot of observers realize. Not amazing, but solid. So I think putting all these things together, the potential for these issues, these are all issues that I think, especially as
regards to Italy are going to take some time to resolve, make us think that over from now until year end, but also out over the next year or two, we still think the path of the euro is going to be higher.
Okay, Andrew, thank you very much. Andrew Sheets, Chief Cross-Asset Strategist at Morgan Stanley.